A bank account holds your money. An investment account grows it or shrinks it, depending on what's actually inside it and how much you're quietly paying to hold it there. Most people open one of these accounts, dump money in, and never look at what's actually happening underneath. By the end of this video, you'll know exactly what account to open, what to put inside it, and the one number that determines whether you retire comfortable or retire broke, even if you invest the exact same amount of money as someone else. Let's start with the basics. An investment account isn't itself an investment, it's a container. What determines your returns isn't the account, it's what you put inside it. Stocks, bonds, index funds, ETFs, or mutual funds. The account just determines the tax treatment and the rules around your money. The first type is a standard taxable brokerage account. This is the most flexible option available. There's no contribution limit, no income restriction, and no withdrawal penalty. You can put in as much as you want and take it out whenever you want. The trade-off is that you pay taxes on it every year. If you sell an investment for a profit, that's a capital gain, and you owe tax on it. Hold the investment for under a year before selling, and it's taxed as a short-term capital gain at the same rate as your regular income. Hold it for over a year, and it qualifies for the long-term capital gains rate, which is significantly lower, often 0%, 15%, or 20%, depending on your income. This single distinction, holding an investment for just one extra day past the 1-year mark, can be the difference between paying ordinary income tax rates and paying a fraction of that. Inside a brokerage account, you have several choices for what to actually buy. An index fund is a pooled investment that simply tracks a market index, like the S&P 500, instead of trying to beat it. Because there's no active manager picking stocks, the fees are extremely low. An ETF, or exchange-traded fund, works similarly to an index fund, but trades like a stock throughout the day instead of pricing once at market close. A mutual fund is actively managed by a professional trying to outperform the market, and it typically charges a much higher fee for that attempt. Decades of data consistently show that the vast majority of actively managed mutual funds fail to beat a simple, low-cost index fund over the long run. The second type is a Robo-Advisor account. This is technically still a brokerage account, but instead of picking your own investments, an algorithm builds and manages a portfolio for you based on your risk tolerance, age, and goals. Robo-advisors automatically rebalance your portfolio over time and often include a feature called tax loss harvesting, which sells losing investments to offset gains elsewhere and reduce your tax bill. The management fee is usually a small percentage of your assets per year, somewhere around 0.25%, which is dramatically cheaper than a human financial advisor, who typically charges closer to 1%. For someone who doesn't want to pick individual investments themselves, a robo-advisor is often the simplest way to get diversified, low-cost exposure to the market without doing any of the work. The third type is a 5-to-9 plan, designed specifically for education savings. Contributions grow tax-deferred, and withdrawals are completely tax-free as long as the money is used for qualified education expenses, tuition, books, room, and board, and in many states, even K-12 private school tuition. Each state runs its own 5-to-9 plan, and many states offer a state income tax deduction for contributions, though you're not required to use your own state's plan. The money can be used at any accredited college in the country, not just schools in the state where the plan was opened. One feature that surprises people: if the original beneficiary doesn't end up using all the funds, the account can be transferred to a different family member, including yourself, without losing the tax benefits. As of recent legislation, unused 5-to-9 funds can also be rolled into a Roth IRA for the beneficiary under certain limits, which removed one of the biggest historical risks of overfunding the account. The fourth type is a custodial account, often called a UTMA or UGMA account, set up by an adult on behalf of a minor child. Anyone can contribute to it, and the funds can technically be used for anything that benefits the child, not just education. The catch is that the account legally belongs to the child once they reach the age of majority in their state, typically 18 or 21, at which point they gain full control of the funds, regardless of what the original intent was. Custodial accounts also count more heavily against a student in financial aid calculations than a 5-9 plan does, which is an important consideration if college financial aid is part of the plan. One more thing worth understanding before we get to the math: diversification. Putting all your money into a single stock, even a company you believe in, exposes you to risk that simply doesn't exist if you're spread across hundreds or thousands of companies through an index fund or ETF. A common rule of thumb for asset allocation is subtracting your age from 110. That's roughly the percentage of your portfolio that should be in stocks, with the rest in more stable assets like bonds. A 25-year-old might hold 85% stocks, 15% bonds. A 60-year-old approaching retirement might flip closer to 50-50 since they have far less time to recover from a market downturn. This isn't about predicting which individual stock will perform best. It's about making sure no single company, sector, or event can wipe out a meaningful chunk of your savings. The investors who panic sell during a market crash almost always lock in their losses permanently. The investors who stay diversified and simply leave their money alone tend to recover everything the market eventually gives back, because historically, the market has always trended upward over long enough time horizons, even after its worst crashes. Now, here's the number I promised you. 2 people each invest $500 a month for 30 years, earning the same average 8% market return before fees. The only difference is the fee they pay. One person invests in a low-cost index fund, charging a 0.05% expense ratio. The other invests in an actively managed mutual fund, charging a 1% expense ratio, which sounds small, almost irrelevant. After 30 years, the low-fee investor ends up with approximately $745,000. The high-fee investor, despite contributing the exact same amount of money and earning the exact same market return, ends up with approximately $611,000. That's a difference of over $130,000, caused entirely by a fee difference of less than 1 percentage point per year. The fee doesn't just take a small bite each year, it compounds against you every single year for 3 decades, quietly eating a larger and larger slice of money that would otherwise have kept growing. Most people never check their expense ratio. They assume a small percentage couldn't possibly matter. What actually separates people who build real wealth from people who don't usually isn't which account they chose. It's whether they understood what was happening to their money once it was inside it. None of this requires being a financial expert. It just requires knowing what to actually check before you click confirm. Subscribe if you want more of this. There's a lot more ground to cover. See you in the next one.